A few years ago, I forgot to pay 100 rupees on my credit card. In the next billing cycle, the bank charged me an extra 1,332 rupees. As soon as I saw the bill, I called the bank. And when they explained the calculations to me, I decided that I would never leave any outstanding amount on my credit card again. That day, I learned a lesson. If credit cards are used properly, they offer a lot of benefits like free lounge access at airports, discounts during sales, reward points for shopping, and so on. But if you are unable to make full repayment, credit cards can become a big burden in your life. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss about the basics of investing and personal finance. In today's video, we'll talk about how banks calculate interest on credit cards, why I had to pay 1,332 rupees on an outstanding amount of just 100 rupees, and what hidden charges you need to watch out for. Usually, a credit card's billing cycle is around 50 days. This means that for up to 50 days, credit card companies don't charge you any interest. Let's say your billing cycle starts on 1st May. Then from 1st to 31st May, you won't be charged any interest or penalty. After that, your bill is generated and you get around 20 days to make the payment. So your due date will be around 19th or 20th June. That means you don't have to pay any interest or penalty for up to 50 days. That is how credit cards are structured. But if you don't pay your bill on time, the credit card company starts charging you interest on a daily basis. Let's understand this in more detail in the next segment of the video. Here we'll look at 4 different scenarios. First, what happens when you don't pay the full amount? This is what happened to me. In the second scenario, we'll see how banks charge interest and penalties if you don't pay by the due date. Third, we'll consider what happens if someone only pays the minimum amount due. And fourth, if you convert your credit card bill into EMIs, how is interest calculated in that case? So let's start with the first scenario. My bill in the first month was 50,100 rupees. I paid 50,000 and forgot to pay 100 rupees. Next month, I made additional purchases worth 30,000 rupees. So in the next billing cycle, my total amount was 30,100. Since I had kept 100 as outstanding, the credit card company charged 3.75% interest on the entire 30,100. That came to approximately 1,129. In addition, the credit card company charged GST of 203 on the interest. So I had to pay around 1,332 in total. That means for keeping just 100 unpaid, I had to pay 1,332 to the credit card company. That's why I decided to pay my entire outstanding amount on time every month. Now let's talk about the second scenario. For this, let's take a new example. Let's say your credit card bill was 10,000 rupees and you couldn't pay it by the due date. As soon as the due date is missed, the credit card company will add a late payment fee to your bill. For instance, SBI Cards charges a late payment fee of 750 if your outstanding balance is between 1,000 and 10,000 rupees. On top of this, 18% GST is also applied. So on a 10,000 bill, your late payment fee will be 885 and the interest charged will be around 800. Let's understand how this interest is calculated with a simplified example. Suppose you made 3 transactions. 3,000 on 1st January, 2,000 on 5th January and 5,000 on 10th January. So your total bill was 10,000 rupees. The bill was generated on 31st January and the due date was 19th February. Now let's assume one more thing. You made the payment 19 days after the due date, that is on 10th March. If the monthly interest rate is 3.75%, then the daily interest rate will be 0.125%, which will be charged on the outstanding amount. Each transaction will be charged interest separately and you'll have to pay around 800 extra as interest cost. If we look at the overall payment, the credit card company will charge you approximately 11,681 because you did not make the payment by the due date. Your credit score will also be affected. Now let's look at the third scenario, when you pay only the minimum amount due. For bill payment, credit card companies give you 2 options. Either you pay the full bill or just the minimum amount due. Usually the minimum amount due is 5% of the outstanding balance. Now, paying the minimum amount due means the company won't charge you late fees. All other calculations are the same as in our previous example. But here's a big question. When you pay the minimum amount due, does this money reduce your principal balance or the interest amount? Usually, payments are allocated in the following order. First, if there is any interest or fees on the bill, that amount is applied first. After that, the remaining amount is used to reduce your outstanding principal, starting from the oldest transaction. And interest will continue to be charged on the remaining balance until the bill is fully paid. Let's say your outstanding balance is 10,000 rupees and you only pay 5% minimum amount. It will take you 20 years to reduce the outstanding balance to 500 rupees. Next, let's look at the fourth scenario. Credit card companies offer the option to convert high value transactions into EMIs. The EMI tenor ranges from 3 to 24 months. And depending on your financial situation, you can choose the tenor. Now, there are multiple benefits to converting high value transactions into EMI. First, it helps spread the amount. This makes the bill more manageable and the chances of default decrease. Second, no late fee penalties are charged. Third, when you have an outstanding balance, interest is charged on a daily basis. In the case of an EMI, the interest is fixed and typically ranges from 18% to 24%. So let's say your credit card bill is 30,000 rupees. You convert it into a 6-month EMI at an 18% interest rate. So your EMI will be approximately 5,450. In these 6 months, you will pay a total interest of 2,700 rupees. But there's one thing to keep in mind. When you convert your balance to EMI, the credit card company may also charge a processing fees. Another benefit of EMI conversion is that it doesn't impact your credit score. It's important to mention one more thing here. You can also withdraw cash using your credit card, but you should avoid doing so. When you withdraw cash using a credit card, you have to pay the bank's usual interest rate, which could be around 45% annually. And the credit card company charges interest on this withdrawal from the very first day. Additionally, you'll have to pay 2.5 to 3% cash withdrawal fee. Cash withdrawal using a credit card is very expensive, so it's best to avoid it entirely. So let's do a quick recap of everything we have discussed so far, so you can clearly understand how interest and penalties work on credit card transactions. First, if you don't pay even a small amount, it can cost you heavily. Second, if you don't pay by the due date, late fees and daily interest will be charged. Also, your credit score will be impacted. Third, if you pay the minimum amount, you won't have to pay a late fee, but the credit card company will charge interest on a daily basis. Fourth, if you choose the EMI option, no late penalty fees will be charged and your credit score won't be impacted. In this case, the interest rate charged will be based on the EMI terms, which is usually lower than the standard charge. Fifth, cash withdrawals are expensive, so you should avoid them. I hope this video has been informative for you. If your family or friends use credit cards heavily, make sure to share this video with them. It could be really helpful.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.